Hi, Stephen here. Today I'm going to talk to you about how to mature a pension plan. The world of pensions has become much more complex over the years. So when it comes to retirement, people don't know where to start when it comes to maturing their pensions and starting retirement. So I'm going to go through the options today and show you how to mature a pension plan. So there are some differences between company pensions and personal pensions and PRSAs. So we'll go through those options briefly before details on how to mature the pension plan. For the purposes of this video, I'm going to assume it's defined contribution and not defined benefit. So you have a company pension. You have two paths that you can go down when you're maturing the pension. The first one is you can take a tax-free lump sum of up to 150% of your final salary as a lump sum and purchase an annuity with the remainder. The other option is take 25% of the value tax-free and invest the remainder in an ARF or take tax cash. With personal pensions or PRSAs, it's a lot more straightforward. You take 25% tax-free, and with the remainder you can purchase an annuity, invest in an ARF, or take it as taxable cash with the remainder. Okay, so look at what an annuity is. Okay, this is in exchange for your pot of money. You give it to the insurance company, and they will give you a fixed amount for as long as you live. You don't have to purchase an annuity with the insurance company that you have your pension with. You can shop around. And while every insurance company will offer an annuity, not are all competitive in the market, so it really is best to shop around. But unfortunately, you can't get the rates in one place. And it can be difficult to get the rates by ringing a financial advisor will be able to get them for you quickly enough and the best rate. So when you've chosen what annuity you want, you complete pension maturity form for your pension provider, informing them of the tax-free lump sum that you want to take. 150% final salary for company pensions, 25% of fund value for personal pensions and PRSAs. You want to take the annuity option with which provider. You return your pension policy documents. If you can't find them, a lost policy declaration will have to be completed. Proof of date of birth, which passport or driving license. Then to implement the annuity, you'll have to complete another form telling the provider what kind of annuity you want and when it's to commence. Again, proof of age is required. Once it's processed, it's paid into your bank account for the rest of your life, just like a salary. Then we have the ARF option. You're now going to manage your retirement income yourself, so there's a lot more work involved. The danger with an ARF is that you'll exhaust the fund too early. This can happen through taking too much risk and there being too much of a stock market crash, or taking too little risk and the fund being depleted by withdrawals because there's no growth at all. So as with all pension and investment clients, I follow the same investment process when advising them on their money. So we do psychometric risk profiling questionnaires, assessing suitability, including gauging how your lifestyle would be affected in a worst case scenario, and what losses you may suffer from it. We agree the investment strategy that you're comfortable with, and then part of my work as an advisor, giving retirement or life advice, we research the market for you, the most suitable funds and best contract to match your needs. So when we've gone through that process and we've chosen provider and strategy, again, the pension maturity form is completed, informing the provider of your tax-free lump sum choice, which would be 25% of the fund. You want to invest in the ARF and what provider you want to go to. Again, original policy documents go back. Proof of date of birth again is required, and then an ARF proposal form going through what funds you want to have, how much you want to withdraw as income, how regular it is, whether you have a guaranteed income of 12,700. So otherwise you have to invest in an AMRF or purchase an annuity for that for 63,500. So under some contracts there are maximum amounts you can take out each year as regular income, but that's very much being done away with by providers, that they are providing unlimited access as long as you withdraw it, and not transferring it to another provider. So unlike the annuity option, you're now in control of your retirement fund and must be managed and reviewed at regular intervals to make sure it's carrying on to do what you wanted to do. The other option is taxed cash. So it's a process same as with the ARF, with the exception that instead of investing in an ARF, you take it all out as one big lump sum, and pay tax on it immediately. You do have to meet the requirements of 12,700 guaranteed income, or else you have to invest it in an AIMRF. But one thing to remember for all of them, annuities, ARFs and taxable cash, they're all taxed under PYE, and so you're no longer working. You move your tax credits to the insurance company that's paid, so they can manage it for you. So it's like they pay like exactly like salary. You get payroll, you get pay slips, P60 at the end. Well, P60s are done away with, but it's managed like payroll. So if you have any questions at all, drop me an email at stephen@bluewaterfp.ie or give me a call on 086 020 6087. Talk to you soon. Thank you. Bye.